All right, let's dive in. Today, we're going to take a peek behind the curtain. Try to understand how Warren Buffett, the Oracle of Omaha, picks those winning companies. And we're using The Warren Buffett Way by Robert G. Hagstrom to guide us. You know, most people, when they think of Warren Buffett, they think stock pickers, but really, his genius, it's about identifying exceptional companies.
Exactly. It's more than just looking at the stock prices. It's dissecting the whole business.
Oh, for sure.
And Hagstrom, he breaks down Buffett's approach into these categories he calls tenets. Business tenets, management tenets, financial tenets, and then value tenets.
So today we're tackling the business tenets, the fundamental characteristics, right? The things Buffett looks for before he even considers buying stock.
The foundation of his strategy.
Yeah. So we're going to uncover the 3 core principles that fueled his success. Maybe learn how to apply them to our own investment decisions. Who knows?
You'll hear about some of the companies in his portfolio too, like Coca-Cola, the Washington Post, even a cowboy boot company.
A cowboy boot company. Oh, I got to hear. Okay, so business tenet, #1. Is the business simple and understandable? You'd think someone like Buffett, dealing with these huge sums of money would thrive on complexity, but he actually prefers simplicity.
He does, yeah. He actually once said that trying to solve really difficult business problems is like trying to jump over a 7-foot hurdle. He'd rather step over a 1-foot hurdle. He sticks with what he understands.
It's funny because it seems so simple, right?
It is.
So if you can't explain the business model to a friend at a barbecue, you should probably steer clear?
Yeah, it's not a bad rule of thumb.
Yeah.
For example, Benjamin Moore paints.
Yeah. Okay.
Buffett acquired them in 2000.
Okay.
And, everybody understands paint.
Right. But he paid a premium for that company. And that seems to, clash with his buy low philosophy, doesn't it?
It does, but it illustrates, a really key point. He's willing to pay more for quality.
Okay.
And Benjamin Moore had quality in spades. They turned paint, into a franchise.
Right.
Because they focused on the quality and that really advanced color matching system. They really understood what their customers needed, and then they delivered.
Really focused on the customer there.
Yeah.
It makes you think differently about, what a franchise can actually be.
Exactly.
Okay, let's move on to business tenet, #2. Does the company have a consistent operating history? I think we've all been tempted by those hot stocks and turnaround stories at some point.
Oh, yeah.
Right? You see something going up and up.
It's a very common trap to fall into.
Yeah.
But Buffett, he avoids those completely. He looks for companies with proven track records. So consistent earnings, reliable products or services. He wants to see stability.
So past performance matters.
Yeah.
Even if it's not a guarantee of the future, but it's got to be a better indicator than just betting on hype, right?
Whoa, yeah, absolutely.
Yeah.
Take Coca-Cola, for example, one of Buffett's most famous investments.
Huge, yeah.
They've been selling basically the same product for over 120 years. A century ago, their syrup sales were just over 100,000 gallons a year. Now, fast forward to 2003, they're selling over 19 billion cases.
That's insane.
Yeah. So that's consistency, A&D, incredible growth.
Over more than a century.
Over more than a century.
That's wild. So another example of a company with consistent performance, the Washington Post.
Right. And Buffett actually had a childhood connection to the paper. He delivered it on his paper route as a kid.
Oh, wow. Full circle. That's awesome.
It is. But putting sentiment aside, it represented something important to him, a stable business with, what he calls franchise qualities. It's a term that we'll explore a little bit more with the next tenet. But essentially, it was a company with a durable competitive advantage.
Okay, so that leads us nicely into business tenet, #3. Are the company's long-term prospects favorable? So this is where Buffett's looking into the future, right?
Exactly, yeah. He seeks out companies with a durable competitive advantage, what he refers to as a moat.
A moat. I love that analogy.
Yeah, he even uses this, vivid image. He pictures a castle with a wide moat, and it's filled with piranhas and crocodiles, and it's protecting it from invaders.
That's an image that sticks with you. Okay, so how do we translate that into something actionable for us, the everyday investor?
Well, think of it like this. Companies with strong moats, these franchises, they can raise prices, right, without losing customers. They can withstand inflation, and they can weather those economic downturns better than commodity businesses. They have that protection.
Okay, so give us some examples of companies that have these favorable long-term prospects.
Sure. So Coca-Cola, again, is a classic example.
Of course.
Remember Roberto Goizueta,
Yeah.
the CEO that turned the company around in the 1980s? He really made it even more appealing to Buffett because he focused on maximizing the efficiency and the returns. He was basically making the moat deeper.
Fortifying the castle.
Exactly.
Okay, I have to ask about this next one, though. This is a curveball. Justin Industries. What do cowboy boots and bricks have in common?
They both fit perfectly into Buffett's framework.
Really?
Yeah. So Justin Boots and Acme Bricks, which were the two divisions of Justin Industries,
Okay.
they both achieved that franchise status.
Yeah, they had the moats.
Hold on. How do bricks become a franchise? Doesn't exactly scream exciting investment.
But Acme Bricks, they really became like the dominant brand through some really clever marketing. They focused on quality, and then they offered like this unheard of 100-year guarantee.
100-year guarantee on bricks.
100-year guarantee on bricks. That's confidence.
Yeah.
Right? And they built this brand in a market where quality and consistency weren't always there.
Right.
Justin Boots, on the other hand, they like conquered the Western boot market through acquisitions and this focus on like real craftsmanship and then also just savvy marketing.
So they weren't just selling boots, they were selling a lifestyle. That's the power of a
Yeah.
brand with a moat, right?
Exactly.
Yeah.
It makes you think about all the companies that you interact with every day. And do they have those moat qualities?
That's the question. And remember, Justin Industries, they also had a long history of consistent profits. So that second tenet's always in play.
Right. They're all interconnected. So we've learned that he looks for businesses that are easy to understand. They have that track record of consistent performance, and they possess this durable competitive advantage, the moat. And it seems like these are principles that anyone can apply, even if we don't have billions of dollars to invest.
Oh, absolutely. It's about shifting your mindset. Instead of chasing those short-term gains, it's about understanding that long-term potential of a business.
I like that. Long-term potential. Okay, well, we've only just scratched the surface of Buffett's world, so stay tuned as we dive into the next category of his investment philosophy, management tenets.
All right, welcome back. I hope you're ready to dig even deeper into the mind of Warren Buffett. So we've talked about how he really likes those solid businesses, the ones that are easy to understand.
Right, those simple businesses.
But even the best business, it can go downhill if it doesn't have the right people running it.
Yeah, a great idea can only take you so far.
Is he
You've got to have a solid team behind it. So how does Buffett go about evaluating those people, the people that are actually running these companies that he's considering buying?
He's looking for managers that exhibit three kind of key qualities.
Okay.
Rationality, candor, and then also the ability to resist what he calls institutional imperative. And these qualities, they really make sure that the people who are running the companies are making smart choices and thinking about the long term.
So it's not just about the numbers, it's about the people behind the numbers. Let's break these down one by one, right? So rationality, that seems pretty straightforward. You want a leadership team that can make smart decisions, logical decisions.
Yeah, exactly. Buffett wants managers who, they're putting the shareholder value first, they're allocating capital responsibly, and they don't let their emotions cloud their judgment. They need to be able to see beyond just like the short-term ups and downs and really focus on what's going to be best for the company years down the road.
No rash decisions based on what Wall Street's doing that day.
Exactly, yeah.
Got to keep your eye on the prize.
He's a long-term investor, and he wants the managers to have that same perspective.
Right. Got to be on the same page.
Yeah, he wants them to act like owners.
Makes sense. Okay, what about candor? What does Buffett mean when he talks about candor?
So he's looking for managers who are honest and transparent with their shareholders, even when things aren't, perfect.
So no hiding bad news.
No.
Because honesty builds trust, even in the world of finance.
Exactly, yeah. It's essential for building a strong relationship with the shareholders, but also just for maintaining a healthy corporate culture.
Right. Okay, so let's talk about this last one. This is interesting. Resisting institutional imperative. What is that?
So it's this tendency that he noticed in like big organizations. So these managers start they prioritize the needs of the institution, like the company itself, over the needs of the actual shareholders.
So they forget who they're really working for.
Right. They're focused on building their empires and kind of protecting their own turf rather than maximizing returns for the people who actually own the company.
So concerned with appearances, not results. I bet Buffett sees right through that.
He does, yeah. He wants managers who are independent thinkers,
Mm.
people who are willing to challenge the status quo and always put the interests of those shareholders first. That's why he tends to favor companies that have a decentralized structure, where the managers have a little more autonomy, a little more accountability. He believes good managers, they don't need to be micromanaged.
So it really is important to understand who is running the company, not just the numbers, but the management team.
Oh, absolutely. It's about understanding the people who are making those big decisions.
Right. And Buffett's management tenets give us a great framework for doing just that. So we've talked about the business, we've talked about the people running it. Now let's talk about the money, the nitty-gritty of the financials. I imagine this is where his brain really starts going.
Yeah, this is where it gets fun. So we're moving into the financial tenets.
Okay.
This is the next piece of Buffett's investment philosophy. He looks at a company's financial statements like a detective at a crime scene.
Oh, wow. Okay, he's looking for clues.
Exactly, yeah. So he's looking for four main things: high return on equity, healthy profit margins, conservative debt levels, and then a consistent history of generating more cash than they actually spend.
Okay, let's take these one by one. So return on equity,
ROE.
ROE, yeah. That's a measure of how efficiently the company is using its shareholders' money to generate profits.
Right. Buffett sees high ROE as a really good sign of a well-managed and profitable business. And he likes companies that can generate strong returns without needing to constantly reinvest a huge chunk of their earnings back into the business.
So it's not just about making money, it's about making money the smart way.
Right. Exactly.
What about profit margins?
Yeah, so he likes to see those nice, strong profit margins. And this basically tells us that the company has some pricing power, right? They have control over their costs.
So they're not just breaking even, they're actually making money.
Exactly. And this gives them, flexibility to reinvest, to grow the company, maybe pay some dividends, or just weather those economic storms that are going to inevitably come.
Speaking of weathering storms, Buffett is known for being conservative when it comes to debt.
He is, yeah. He definitely prefers companies with low debt levels, or at least manageable debt levels. Because high debt, that can eat into your earnings. It can make a company really vulnerable when times are tough. And remember, he's looking for those companies that are going to be around for a while.
Built to last.
Exactly.
He's not a gambler. He's not looking for those quick wins.
Though slow and steady often wins the race. And this brings us to maybe the most important financial metric of all: cash flow.
Cash flow. Yeah, it's the lifeblood of any business.
It is, for sure. Buffett wants to see those companies that are consistently generating more cash than they're spending. This means that they're not relying on outside financing to stay alive, and they have those resources available to invest in growth, to pay dividends, or even make acquisitions.
So healthy cash flow, healthy business, basically.
That's a great sign.
Okay, so we've covered the business tenets, the management tenets, the financial tenets. So we've looked at the business, we've looked at the people running it, and now we looked at the financial health of the company. But one piece is missing: the price.
And that's where we come to the final category,
Okay.
the value tenets. And this is really where his approach becomes unique. He's not just looking for good companies. He's looking for great companies at a great price.
He loves a good deal.
Yeah. But his idea of a deal might be a little bit different than, the average person. He's not running after that lowest sticker price, He's looking for what he calls the intrinsic value.
Okay, can you explain what intrinsic value is? Because that sounds a little complicated.
Yeah, so basically it's trying to estimate the present value of all of the company's future cash flows.
Okay.
So it's about understanding what the company is really worth, regardless of what the stock market is doing on any given day.
So you're looking beyond all the hype and the fluctuations and the noise and getting to the core of what the company's actually worth.
You got it. And he believes that the best investment opportunities happen when the market price of a stock is much lower than that intrinsic value. He wants to buy $1 for 50 cents.
Okay, and this is where his famous margin of safety comes in.
Yeah. Even when you do your best analysis, you could be wrong. So he builds in a cushion to protect himself from, errors or unexpected events.
Smart. So he's not just brilliant, he's also cautious. He understands that every investment has a risk.
Exactly, yeah. His value tenets, they're all about minimizing that risk while maximizing your potential for return. Now, to really illustrate this concept of intrinsic value, let's talk about one of his most famous acquisitions, Geico Insurance.
Okay, yeah. Geico, I mean, they're everywhere now. Everyone knows that gecko. How does that fit into, like, Buffett's framework?
So Geico, it actually represents a lot of his tenets really well.
Okay.
First of all, the business model is super simple. They sell car insurance directly to people. They cut out the middleman. So they cut out a lot of extra costs.
So that right there, that's the first tenet. Simple, understandable business.
Exactly.
Check.
He first invested in Geico in 1951. And right away, he was really impressed with that low-cost model and how efficient their operations were. He saw that they had huge potential to generate great returns on equity and that strong cash flow.
Okay, so hitting those financial tenets too. But how did he go about figuring out the intrinsic value of Geico? Like, how do you put a number on that?
So he spent a lot of time studying Geico's financials, analyzed everything. Their loss ratios, their underwriting practices, their potential for growth. He actually projected their future earnings and then discounted those earnings back to their present value, taking into account things like risk and the time value of money.
Okay, so this is getting a little complex.
Yeah, it is, but it's the foundation of value investing.
Okay.
And through this process, he determined that Geico was worth way more than the stock market was saying at the time. That's how he saw that opportunity to, buy a dollar for 50 cents, which is the dream.
And this was back in the 50s.
Yeah.
Before they were a big name, before all those commercials.
Long before the get-go. And his conviction and his analysis, it eventually led him to acquire the whole company in 1996. And it's been one of his best investments. It made billions for Berkshire Hathaway.
Wow. It really highlights how understanding that intrinsic value can really pay off. Makes you wonder what other, hidden gems are out there just waiting for someone to find them.
That's the exciting part of investing.
So we've spent all this time talking about this framework that Warren Buffett uses to make his investment decisions. We've got the business tenets, the management tenets, the financial tenets, even that idea of value tenets and intrinsic value. But what happens when, even with all that, the companies that he's picked, they face unexpected trouble. The markets are unpredictable.
Yeah, that's true. Even companies with, strong moats and amazing management, they can still hit a rough patch. But that's the thing about Buffett's approach.
Okay.
It kind of helps him navigate those tougher times.
So how does he decide when to hold on to a company, when things aren't going so well versus when it's time to just, cut your losses and run? I'm guessing it's more than just looking at the stock price every day.
Oh, for sure. Yeah. When a company in his portfolio starts to, underperform, he goes back to those basic tenets that we talked about, those core principles.
Right.
He asks himself, is this business still simple and understandable?
Yeah.
Has something fundamentally changed?
Yeah.
Is the management team still showing rationality and candor? Are they resisting that institutional imperative? And then are the financials still looking good? High returns, good margins, strong cash flow.
Like a checkup for the company.
Exactly.
Making sure everything's still healthy.
Yeah, and if the answer to all those questions is still yes, then he's likely to hang on, even if the market's going crazy, because he gets that a lot of those short-term changes are driven by, emotions, fear, not logic. If he still believes in the company, he's willing to wait it out.
Which takes a lot of discipline. I mean, I know I get antsy when I see my portfolio dipping, but what if those answers start to change? What if, the business model is not so simple anymore? Or the management team, they're not performing so well? Or the financials start to slip?
Then he's not afraid to, make a move. He'll sell. Because he understands that sometimes, even the best companies, they can lose their way. And he's not afraid to admit, hey, maybe I was wrong about this one.
Yeah, I think that's hard for a lot of investors, myself included. It's easy to get attached, even when, the signs are telling you maybe it's time to move on.
Yeah, but Buffett avoids that by,
Yeah.
Sticking to those principles. He's constantly evaluating everything,
Yeah.
He's watching for any signs of weakness. And he's prepared to sell if those fundamentals don't support his original thinking.
It's like investing is never really done. You constantly have to learn and adapt and kind of reevaluate your decisions.
Yeah, exactly. And that's part of what makes Warren Buffett so great. He's not stuck in his ways.
Yeah.
He's flexible.
Yeah.
If the facts change, he changes his mind.
So as we wrap up our deep dive into Warren Buffett, what's the one piece of advice you would give our listeners? What's the most important takeaway from all of this?
Honestly, I think the biggest thing we can learn from Buffett is to focus on the fundamentals. Don't get swept up in the hype or the day-to-day noise of the market.
Right.
Do your research. Understand the businesses that you're putting your money into. And remember, Price is what you pay, but value is what you get.
It's about investing in companies, not just like ticker symbols, thinking long term, being patient, and sticking to your guns.
Yeah, and never stop learning. The world of business is always changing, right?
Right.
So our investing approach has to change too.
It's been a wild ride exploring the mind of Warren Buffett, and I feel like we've all learned so much from him.
I hope so. And remember, you know, even if we don't all become billionaires like Buffett, taking even a couple of his principles to heart can make us all better, smarter investors.
And on that note, I think it's time to wrap up this deep dive. Thanks for joining us as we explored the investment philosophy of Warren Buffett. Hopefully you found it helpful and maybe even a little inspiring. We hope you'll join us again next time. Until then, keep learning, keep exploring, and as always, happy investing.